Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Herman Chan. He's a senior banking analyst at Bloomberg Intelligence to discuss what's causing banks to be more cautious about lending. Herman, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill.
Let's talk about this from a higher level. Does this have anything to do with the interest rate environment we're in right now,
Right.
Fed policy, the fallout from the banks earlier in the year, or is it something different that's putting a pause on lending?
It's all the above. The banks are facing some difficulties in the current environment. You mentioned higher interest rates, so the banks are having to pay up for deposits, which means there's a higher threshold for lending and being able to lend at profitable levels. That's one. Number two, there's tougher regulatory environments. So the regional banks will need to adhere to higher capital ratios, higher liquidity requirements, and that all just means that banks are really inwardly focused, trying to shore up their capital base, and one way to increase capital is not to lend. So that's the second issue. The third is that there's some less demand across the regional bank customers, and most regional banks really primarily lend to business customers, small businesses, medium businesses, less so on the large corporate side. So there's a bit of a tempered demand given where the rate environment is today, and some uncertainty where the economy is going to go going forward.
So they have to pay up more for deposits. They clearly make fees on lending, which of course, you know, if you're not lending, you're not getting those fees. How is this impacting their margins? Have you seen anything significant?
Right. So the net interest margins for the banks are coming down, and this is just a function of the interest rate cycle that we're in today. Recall last year when rates were starting to go up, the banks were actually gaining increased profits because of that. Now with where rates are and how they rose so fast, compounded with what happened with SVB and Signature and First Republic, those bank failures, a lot of the banking customers saw opportunity to really diversify out of the regional banks and saw some opportunities in areas like money markets and CDs where you can get a bit of a higher yield. So those customers are tending to shy away from keeping their deposits within a bank. So the banks are needing to compete with that higher competition, which increases their funding costs.
Right. Well, I mean, you know, what are rates? They were what, 0.1%,
Right.
0.01%. I mean, for years, and then you start to see 4.15%,
Right.
4.5%. I mean, and not even just for business customers, but for consumers as well. I mean, personally, I've taken advantage of it.
Right.
Would you say that the capital and liquidity requirements are as stringent as it was following the financial crisis?
The banks will need to step up a little bit on the regional bank side in terms of increasing their capital. We've seen a bit more clarity as the regulators like the Federal Reserve and the FDIC just yesterday offered some specifics in terms of some rules on long-term debt.
Right.
So you're going to see, the regulators had mentioned potentially 6% higher capital requirements for the regionals across some of the banks that are sort of in that regional bank space. Much lower versus the largest competitors, but still something that they need to adhere to. And then there's the other issue of, as you recall back in March and April with SVB, they were sitting on a large unrealized loss position in their securities portfolio, which ultimately made the market and their depositors lose confidence in that bank. So the regulators are looking to incorporate those unrealized losses into the capital calculations.
And you said this isn't impacting the big banks such as JP Morgan as much as it is the regional banks.
Right.
Does it get to a point where the regional banks just can't be competitive at all and we're all starting to use these massive money center banks?
Right, so that is some of the questions that have come up after the fallout in March and April. What we see over time is that there's going to be some consolidation in the regional bank space. Some of these peers that are still maybe lacking a little bit of scale versus the largest trillion-dollar banks like JP Morgan and Bank of America, and dealing with these capital issues and less availability for lending. So it all makes sense for the industry to consolidate, to get that economy of scale to tackle some of these constraints that the regional banks are facing.
Would that impact consumers and small and medium-sized businesses? You know how important regional and community banks
Right.
are to the communities that they serve.
It could on the margin, potentially if you're a, let's say, for example, a commercial real estate developer in a smaller town where there's only a handful of banks that you could rely upon. If you take one out, then maybe there's less opportunity, or you just have to pay a higher rate to get a loan. So and that's something the regulators are really focused on in terms of making sure that competitive landscape stays where it is today.
All right, Herman, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.